Hi everyone, let's start with the concept capsules for today. Today we're going to cover option payoff versus option P&L. We're going to look at what the difference between the two terms is and what's the difference in the formula. So let's start with the four basic option payoff profiles first. Now we have two different kind of options. We have the call option and the put option. Within call option, we can either go long on the call option or short on the call option. Similarly, for the put option, we can either go long on the put option or short on the put option. So first, let's understand what does going long or going short mean and what are the call and put options. Now, one rule of thumb which you should always follow for options, and especially if you're not too conversant with options, let's say you've not traded options, and you're quite an beginner as far as options theory is concerned. The rule of thumb which you should follow is that always and always think from the long's perspective, and for all the formulas on the short side, just multiply the long's formula with -1. Now, why are we asking you to do this? For the simple reason that option is a derivative in which one side has a right and the other side is an obligation. If you were to compare it to a future or a forward, both the sides in a future or a forward contract have an obligation. So the real advantage of options actually, is for the side which has that particular right, and that is the long. So that's why we always think from the long's perspective, and for the formulas for the short, we just multiply those with -1. Similarly, when we have to look at what positions or what kind of an obligation do they have, we again look from long's perspective and do the opposite. How to do that, we'll just see. First of all, call options and put options. Call options is for buying the underlying and put options are for selling the underlying. This is something which you'll see across all the texts. Now, remember, whenever we are talking about buying and selling in this case, again, we are talking about it from the long's perspective, not the short's perspective. Now, long positions have rights and short positions have obligations. Think of option as essentially kind of an insurance contract. So if you want to have the right, you need to pay an option premium or the option price for it. So as soon as you pay that price, as soon as you pay that amount, you have a right, and the opposite party which has collected that premium from you has an obligation because they've sold off the right. Once you've sold off the right, you're left with the obligation. Now, how do we actually use that to interpret these four different positions? If you have a long call position, that means that you have purchased the right because you're long on the option. Similarly, for a long put position, you would have purchased a right because long means that you have the right. Now, what does long call mean? Call is for buying the underlying. So when we put both of them together, that means that you have purchased the right to buy the underlying. So that's what we have. So it's the right to buy the underlying. Now, short call is the opposite party. Let's say if I'm the one who has purchased the call option from you, that means I am long on the call option. That means you are the one who has sold that call option to me. So you are short on the call option. Now, if I have the right to buy the underlying, you automatically have an obligation because you're the one who has sold that right to me. So you have an obligation. If I have the right to buy, that means your obligation is that whenever I want to purchase the underlying, you have an obligation to sell that underlying to me. So short call would mean the obligation to sell the underlying. So that's why we are saying always think from long's perspective, because if you don't do that, then in this case, you might confuse short call. Remember, call is for buying, but from long's perspective. But here, the person is actually selling. So you will end up getting confused. So rather just think from the long's perspective and take the opposite side for the short. So you won't get confused then. Now we do something similar for the long put position. Remember, put is for selling the underlying. So long put means that you have the right to sell the underlying. Now, if you have the right to sell the underlying, what is the obligation of the other party? If I'm selling, the other party has an obligation to buy, which means short put means that it's the obligation to buy the underlying. So that's how we look at the four basic option strategies that we have. So the four basic kind of exposures which you could have. So always think from long's perspective. That's the first rule which we have to follow. Now option premium essentially is something which is also called as the option price. So that is the amount which you need to pay upfront if you want to purchase that right, whether it's for buying or selling the underlying. Now let's look at the option payoffs. Now one confusion which happens is people confuse option payoffs with option P&L. And the reason why this happens is because just before options, you've just done forwards and futures where both the terms are used synonymously. Now I'll tell you what the difference is. Think of payoff vaguely as revenue. Now revenue just means that we're talking about the inflow which is occurring. We're not talking about the cost there because cost would be an outflow. So when we think about payoff, think in terms of revenue from something. So payoff from option means that we're ignoring the costs as of now. When we move on to the P&L from options, that is the profit and loss, there we specifically account for the cost as well. Because how do we calculate profit of anything? We take the revenues and from that we subtract the cost. So when we are looking at only the payoffs, we are ignoring the cost aspect because we are only looking at the revenue aspect. When we move on to P&L next, there we will be adjusting for the cost explicitly. So first, let's look at the payoff from the options and the various formulas that we have. First, we have the long call payoff. Now, just one quick thing, that how do we recognize just by looking at the graph that are we looking at the payoff or are we looking at the P&L? Try to spot for this thing. You see that the x-axis has actually been just bolded. So this particular payoff, most of the part here is on the x-axis itself. It's not below the x-axis, which means that there is no loss which is occurring for the long position. Now, in reality, there will be a slight loss at this point because you've paid an option premium. So till the time that option is out of the money, you will still have a loss there because the premium is already gone from your own pocket. When we talk about the option payoff, remember we are ignoring the costs as of now. That's the reason why this particular line, the graph which you see, is not going below the x-axis. It's on the x-axis itself. Now, after this point, after the strike price, then it starts moving up. Why? Because long call means you have the right to purchase the asset or purchase the underlying. Now, when will I exercise that right? Let's say I have the right to purchase a particular stock at $100. Now, if the market price goes to 120, then that right is very valuable because something which is trading at 120 in the market, I will be able to buy that for $100, which means I make $20 of that particular position. So that's the reason why the formula comes to max of ST minus X and 0. Now, some texts would use the term X, which is for exercise price. In some books, you will see K being used as the notation, which is strike price. Strike price and exercise price is the same thing. So whether you use ST minus X or you use ST minus K, that's completely a matter of your choice. So if we have max of ST minus X, this essentially means that in our example, this becomes 120 minus 100. Now, why are we doing max of this and 0? Because remember, you have a right here. So in case, let's say the market price goes to, for instance, 70. In that case, why would I want to purchase this particular asset at 100 when in the market I can purchase it at 70? I will let the option expire. I won't exercise it. I'll simply buy the stock from the market. In that case, we will go for the second part, which is 0, because ST minus X becomes negative. It would be 70 minus 100, which is minus 30. Max of minus 30 and 0 is 0. So that's why the payoff would become 0 if the option is out of the money. Out of the money means it's not worth exercising. You're not making money off it. Now that's for the long call. So you remember this formula if you want. If you don't want to do it logically on that day, this is the formula which you remember. Short call, if you're not able to remember this or you're getting confused, it's fine. There's no problem at all. All that you do is remember the profit from one party has to be the loss of the other. This is what is called as a zero-sum game, which means that there is no win-win in this particular market. For one person to win, the other has to necessarily lose. So all that we do is, whatever the formula for the long is, we take that and we simply multiply that with minus 1. So for instance, if the long call payoff was coming out to be negative, it would have become minus into minus plus, and that would have been the profit for short call. So that's how we have to look at it. So you can ignore the formula for short call, simply take the negative of long call and you would still have the same answer. Now for long put payoff, what is the formula? Now, when do you exercise a put option? The put option becomes valuable when the price is falling. So in case the market price falls, that's when you exercise the option so that you're able to get a price which is higher than the market price. So this will be exercised when the price is going down. So instead of having ST minus K within the bracket, it becomes the opposite, which is K minus ST or X minus ST, right? Whichever notation you prefer. So that's X minus ST comma 0. That's for long put. We apply the same thing that we just learned for long call versus short call. If we have to look at the short put payoff, it becomes the negative of long put. So we take this particular calculation and we simply multiply that with -1 so that we don't have to remember this other formula. So that's how we do it for the option payoffs. Remember, right now we are only on the revenue stage. We have not subtracted the cost. We have not adjusted the option premium yet. This formula will now be extended to account for the costs. So one person is paying the premium, so the other person is receiving that premium. So let's look at the formulas which we would have there. So those are your option P&L formulas. So long call, short call, long put, and short put. This part, the second part of the formula, is exactly what we did for payoff. The only difference here will be the adjustment for the option premium. Now, if you're long on the call option, you have to pay the call premium, the price of the call option. So that's why this is minus CT. CT is the notation for call option price or the call option premium. PT is the notation for the put option premium. So the long will be paying the premium amount. That's why it's minus CT. The short will be receiving that premium amount and hence it's plus CT. Similarly, long put has to pay the put option premium. That's why minus PT. And short put will be receiving it. That's why it's plus PT. Now, this part, the second part, was the revenue which we calculated in the previous slide. And we have also adjusted the cost. That's why this now becomes the P&L, the profit or loss on that particular option position. So this profit is essentially revenue minus the cost. So obviously, a rough way to think about it, if you have to differentiate between the payoff versus the P&L. Now let's put some numbers into the 4 option positions. So what would be the profit from buying one European call option? Option price is 10 and the strike price is 200. Now, when will you exercise this option? When does it become profitable? Strike price is 200, which means since this is the right to buy the asset, we will only use this right if the price goes above 200. But if the price goes above 200, does that automatically mean that we are in the money or we are making money from that trade? Remember, we have also paid the option premium. So just crossing 200 is not sufficient for us to make money from the trade. We need to recover the option premium which we have paid as well. Now, if we look at this particular graph, you see 200 is here. At 200, this is the point at which your losses start reducing. Till this point, you've already paid the premium and you're not using the option, so that would be a loss. From this point, your losses start reducing. You're recouping your losses. When will you actually break even? You will break even when you have crossed 200 and you've also recovered your option premium in totality, which is 10. So your break-even price now becomes 200 plus the premium which you have paid. After 210 is where your profit is actually going to start. So where would the break-even be? Break-even is obviously here. At this point, you've completely recovered the premium of $10 which you have paid, and this is where your profit starts. So that is how it would look like for a long call. Now think about how it would work for a short call. Remember, break-even point will always be the same for both sides of the trade. The difference would be in the direction. When long call is losing money, that's when the short call would be gaining money. It would be on the opposite side. When long call starts making money, that's when the short call is going to lose money. So it's going to be a mirror image. We just have to reverse this particular graph. What would that look like? We would have it like this. So the break even is still 210, just that after break even, you start losing money. Whereas long call started making money from this point. So the positive of one simply take the negative of that, and that becomes the payoff or the P&L on the other side, right? It's always the opposite. It's a zero-sum game. So that's for long call and short call. Let's do the same thing for long put and short put. Now you have to calculate the profit from buying a European put option. Option price, which is the premium, is $14 and the strike price is $140. Now long put means you have the right to sell the underlying. Now when will you exercise that right? If the market price is going up, you're not going to use this option because you'd rather sell in the market. So this option will become valuable when the market price starts falling. So if the strike price is 140 and let's say the market price goes to 110, then it makes sense to exercise this option because you're able to get 140 for that asset instead of the market price of 110. But remember, we have also paid an option premium. So a price less than 140 does not automatically mean that we're going to start making money. We also have to recover the premium which we have paid, just like what we did for the call option. So if the price starts going below 140, remember, till this point, let's say from 140 to 200, you're out of the money. You're not making any money from the trade. You're not going to exercise the option. Once it goes below 140, you start recouping your losses. Once you've completely recovered $14, that's when your profit actually starts. So your break-even point is here. So your break-even point would essentially be 140 minus 40. Because now, keep this in mind. When we're talking about the call option, you were adding both the figures. Here, we're netting out, we are subtracting the option price from this. Now, why is that? Why? Just look at the direction of the cash flow. When we go in for a call option, we have to pay the price of the asset if we exercise the option, and we are paying the premium as well. In this case, we are paying the premium, but if we exercise the option, we don't have to pay money for that. We are actually receiving money because we are selling the asset. So both are in the opposite directions. So here, 140 minus 14, that becomes your break-even point. Once you go below this, that's when your profit actually starts. Now that's for long put. Short put, similarly, would be in the opposite direction. Break-even point would still be the same, just that here you're losing money. For the short, this is when you would be making money. So let's have a look at that graph. You can see that here. Now for a short put, the maximum profit is limited. Same thing with the short call, the maximum profit is limited because the option premium which you have generated upfront, you cannot make more money than that. Now in this case, obviously the break-even point is still the same, just that the direction of the cash flow changes. The long started making money from this point, short put is going to lose money from this point, but your losses are still going to be limited. You can see that you're going towards the axis. So it's going to be limited. Unlike short call where your losses could be potentially unlimited because there is no limit to how high the price could actually go. Now let's look at a couple of examples. So we look at the option payoff first and then we go on to the option P&L. Now at expiration, the underlying asset price ST is $29. Strike price is $26. What is the payoff of the put and call? Remember payoff, which means we are ignoring the option premium. Now, what would be the payoff to the call buyer? So your final price at maturity is 29 and strike price is 26. So does it make sense to actually exercise this particular option? Remember, there's no option premium which we are using. Now, practically, what would you rather do? Would you buy something at 26 or would you buy something at 29? Obviously, you'd like to buy at 26, which means it makes sense to go ahead and exercise the option. Now, if you exercise, that means how much are you saving? Instead of paying 29, you pay 26. So your payoff becomes $3. If you want to look at the formula, that's again ST minus K, or you can just use logics just like what we did right now. So that comes out to be $3. How about the put buyer, the long put? Does it make sense for that person to exercise? Now this is 29, strike price is 26. If I have to sell, I'd rather sell at 29. Why would I want to sell at 26? Which means I'm not going to use this particular option. If I don't use the option, that means my payoff is 0. So that is option payoff. Now let's look at the option P&L. Now assume that a put and call on XYZ stock both have a strike price of $35. The call costs $2 and the put costs $3. So we know the option premium for both the call and the put. What is the profit on the long call and long put if the price of the stock at expiration is $28? Now let's look at what would be the profit to the call buyer. Now, strike price is 35. The stock price at expiration is 28, which means that it does make sense. Does it make sense to go ahead and use this option? If I were to use this option, then I would end up paying 35, whereas in the market it's trading at 28. I'd rather just go ahead and buy it at 28. Why would I want to purchase that at 35? So in this case, I'm not going to use the option. Now, if I don't use the option, remember, we have already paid the option premium and the call costed $2, which means we end up losing $2. So that's minus $2 because we just let go of the option. We let the option expire without using it. So we have essentially forfeited the option premium. Now let's look at the put option. Now strike price is 35 and expiration is 28. I'd rather sell at 35 than 28, which means I will go ahead and use that particular option. Now, when I use it, how much money am I making? So I'm selling at 35 instead of 28, which means $7 is the gain which I have on this side. But that is not the complete gain, gain which we have, because we have paid $3 as the premium. So $7 minus $3 which we have paid upfront, that comes out to $4. So that is the profit to the put buyer. So that's it, guys, for the option payoff versus the P&L. I hope it made the concept clearer. Just remember, think from long's perspective, and options is going to be a lot more easier. Thank you.